next session is about VA loans, and our guest is Michelle Corridon from the U.S. Department of Veterans Affairs. And so VA loans are kind of a big deal these days. I remember when VA loans were just sort of a niche product or easily overlooked. So I guess first off, Michelle, I'll start by asking you to just walk through some of the changes in the VA program. So it used to be a small part of the market, but it's not anymore.
No, actually the VA market share has grown from about 1% to about 14% last year. Also too, what we found in VA right now is that we had the least amount of decrease in volume as compared to the other federal agencies. We've lost about 20, whereas USDA and FHA have lost a lot more than that.
Why is that? I mean, you're talking about a 14-fold increase in your volume. Rocket Mortgage would love to have that. What's happening? Why is this program so much more popular?
So over the past couple years, the VA's been trying to simplify its process and also make the program more attractive. And some of the ways we've done that is to be able to simplify some of the requirements. And we've also worked very closely with our lender partners to do the same thing. Another huge part of this is making the VA loan the preferred product of choice for veterans. And part of that reason is there's been several bills that have passed in the last 5 years that have reduced the amount of veterans that are required to pay the VA funding fee. So that takes several $1,000s off the table for veterans to pay for, and that has made the program way more attractive.
So, and that veterans fee is, what is it, like a couple thousand, or the VA funding fee is a couple $1,000s?
So there's a chart for it, and it's kind of a sliding scale based on loan amount.
Okay. So, now you talked about improving the program and the funding fees. So one of the things that we probably everyone in this room has heard about is just the stigma that VA borrowers, FHA borrowers have in the eyes of sellers and listing agents. So what's going on there? Is that getting better?
So there's a couple things there that we've been working on. First of all, John Bell, who's the executive director of the Loan Guarantee Service, testified to Congress in December of 2021 exactly about this issue. And so as part of that testimony, Mr. Bell did bring up that, particularly during COVID, it was really tough for any government applicant to get a contract in certain areas. And so one of the things that we did was work with the NAR to try to get some indicators in the MLS that would make it obvious that sellers were not interested in doing government financing on the property. The other thing was to encourage folks and to bring a greater understanding that doing a closing with government financing really wasn't that big a deal, that we could close in 30 days or less. And one of the reasons that we've been able to do that is to try to look at the appraisal process and bring some improvements there. And so one of the improvements in there is the assisted appraisal process, the AAPP, and that is a way for appraisers to leverage other appraisers or trainees to so the trainee could actually do the inspections and the photographs and the notes, and then turn that over to another appraiser to do that. You can also use another appraiser to help them out to do that work. And you can use the AAPP for any work except for $1 million valuations, so anything you think is going to be over $1 million, very complex, or for new construction. And so that AAPP can help us leverage other folks in the appraisal industry to help get appraisals done. The other thing that we have done is the VA has worked very closely with the White House and other federal agencies on PAVE, which is Property Appraisal Valuation Equity. It's a task force that came out in June a year ago. They are just celebrating the release of the first report in June of last year. And one of the things we're looking at and working with the Appraisal Institute and others is the education process for appraisers. Does it still need to be the same way as it was set up in FIREA many years ago? And so we're looking at education requirements, apprenticeship requirements, and working closely with the other federal agencies, housing agencies, and also the Department of Education and the Department of Labor in that space.
Yes.
And so the other thing that will be happening as a result of PAVE is there's some legislation in process to add the VA and the USDA to the appraisal subcommittee. We've never been a member of the appraisal subcommittee and therefore haven't had a seat at the table to talk about all these important appraisal issues. And so that legislation is working its way through Congress right now.
All right, and so you mentioned COVID, and mortgage forbearance was a huge story about 3 years ago. I think we all probably remember at the start of the pandemic, everyone in the mortgage industry very quickly got on the same page in terms of forbearance, so giving borrowers a break with no penalty, no real questions asked. And now that the crisis is over, it seems like the response among the VA and FHA and Fannie Mae and Freddie Mac hasn't been quite as unified. It's a little more all over the place. But what's happening in terms of VA and forbearance for those borrowers who still can't pay their mortgages?
So VA is going to retain all of the loss net options that we have, with the exception of partial claim. That did expire. And one reason is we had to let partial claim expire because it created some budgetary problems for us as a credit agency. But we are keeping all the other loss net options. And because we're not doing partial claims, and I forgot what FHA and USDA are calling their new partial claim. I forgot the phrase for it, but we're not doing that either. So we're going to do what's called VAS, which is the VA Servicing Purchase. And for those of you who are familiar with the VA program, it's going to look a lot like a VA refund. A VA refund is where VA pays the servicer the credit loss, and then VA takes the loan on and begins to service that loan on behalf of the servicer. Under VA Servicing Purchase, after the servicer has taken the veteran all the way through the loss net waterfall, including all of the retention options, we will consider doing the servicing purchase by paying the servicer the remaining balance on the loan, including all delinquencies, fees, charges, advances. And we will take that loan on and start to serve it ourselves as a VA direct loan. We expect to release all the requirements for this on or around July the 1st and institute the program around October the 1st.
Okay. And so you still have borrowers who are in forbearance or having trouble paying their loans?
It's a really small population, particularly for the COVID, the folks that took advantage of the COVID opportunities. But there are still some folks that have either not brought their accounts up to date, refinanced, or paid their loans off. And so that's why we're going to do FAST at the end of the waterfall.
Okay. And so I think the consensus has been, because home prices are so strong, that borrowers who are in trouble can just sell their way out of trouble. They're not going to have to go through foreclosure. What are you seeing on that front? I mean, is that true for VA borrowers?
I think it's true for everybody in the marketplace. This was a big topic of discussion at the 5-Star Servicing Conference in DC this spring, and how this market does not look anything like after the crisis, where there were so many folks underwater. And so servicers, for those folks that will not be able to retain their property, that they have not recovered yet from what's happened to them in COVID. They may still be underemployed, they may have lost a borrower to COVID and cannot make up that difference in income, that they should be having some serious conversations about self-liquidation or selling the property on their own and retaining their equity and their credit score.
Mm-hmm. And so about how many people do you have who are still in some kind of forbearance?
We estimate that, at least for the VAS product, there'll be about 48,000 borrowers in a population that could be eligible for VAS. We don't expect all 48,000 to uptake on VAS, and they'll probably exit with some other loss mitigation.
And just for perspective, 48,000 out of how many loans?
Several million.
Okay. And to come back to that theme of the huge growth in the VA market over the years, so I pretty closely watched the J.D. Power customer service surveys from mortgage originators. The VA lenders are always off the charts. So the big three, the PenFed, USAA, and Veterans United, are always just ranking way at the top in terms of customer service. But why is that? What's going on there that veterans seem to be so happy with their lending partners?
So I think it's just like at the VA. We do everything on behalf of the veteran, and they are shoulder to shoulder with us in providing an excellent level of customer service.
Mm-hmm.
And we're very happy to have those folks as our partners.
And then on the other side of the spectrum, the Consumer Financial Protection Bureau put out an enforcement action a couple of years ago, specifically targeting VA lenders for making false claims in their marketing. Is that more of a problem in the VA market than it is in the mortgage market overall?
I'm not sure if it's more of a problem for veterans. I just think it's more amplified for veterans. Like that spotlight's a little stronger for them because they're veterans and folks feel like they should be treated fairly and not be taken advantage of. So I think it's all across the marketplace. We've seen other customers in the marketplace that are having issues, with their lenders and servicers too. The other piece that I'd like to add to that is there are several past bills and upcoming legislation to further enhance the protections for veterans in the customer space.
Give some examples.
So, for instance, to make sure that organizations that claim to represent veterans are doing it on their behalf and not using it as a grift.
Mm-hmm. And we've heard about veterans or service members being taken advantage of by payday lenders or by auto lenders. Is there any particular thing that you're concerned about in terms of the mortgage market?
So I think it would fall into both origination and servicing. We ask veterans to be very careful about who they partner with to make sure that they're partnering with folks who are reputable, and also to just kind of general customer protections, like how you read in the paper that older folks are a target, and people will call and say, hey, your grandchild has been arrested, send me a bunch of gift cards. It's kind of like that messaging, but more geared towards veterans. And in the servicing space, having them be very careful about who they partner with to help them work with their servicer. If they choose to have a partner in that space, to make sure that they're not giving them a lot of money, and if they feel like the situation kind of makes them feel untrustworthy, to give that thought some real serious consideration and make sure that the person they're working with is trustworthy.
Mm-hmm. All right, any questions for Michelle? Yes.
Do you think that the VA loan model, which seems to be pretty successful in the past 70 years, can be cloned by city and state governments for police officers, teachers, sanitation workers, social workers, others? Is that a model that can be replicable at the local level of partners?
So I believe at some points in time, hasn't HUD done some partnerships like that? I think they did the teacher next door, the police officer next door. I think they had some programs like that. Also, too, I think there are some state agencies that focus on veterans in their loans. And I'm from Virginia, so Virginia Housing Development Authority also does a lot of targeted programs to special groups for special credit programs.
Are they working well?
Yeah. I think there's small populations, so it's really hard to kind of get a beat for that. But the few people that they do help are very happy to have had those opportunities.
Are they working as recruitment tools or retention tools in any way?
So I think that's for Virginia Housing in particular, it's more of retention, but I think they're working their way towards as a recruitment tool. Because as we know, it's tough in a bunch of different localities all across the country to get people to do public service. So my daughter works for the University of Maryland, and they have a great home buyer education support program there, where they do forgivable grants if you buy property in certain parts of the city of Baltimore, Maryland. So they use that for both recruitment and retention.
All right, and so let me switch to the title of our discussion, which is the assumable loans. So the VA loans have a pretty cool and often overlooked feature, which is that as a VA borrower, I can assign my VA loan to a buyer. The buyer can assume the loan. And so that hadn't really been a big deal for a long time when mortgage rates were at historically low levels forever. But now that we've had mortgage rates double in the past 2 years, there's been a lot more interest in buyers assuming VA loans. So I mean, it'd be a great deal if I can buy somebody's house who's a veteran and assume his 3% loan. But so I guess how frequently is that happening, and just how common is it for somebody to be able to assume, for a buyer to be able to assume a VA loan from a borrower or from a seller?
Well, it's been a really, really tiny piece of the marketplace up until rates went up here in the last year. So first of all servicers must process VA assumptions. And so if a veteran comes to you and says, I want somebody to assume my loan, the servicer must do that. There's a new circular out, 26-23-10. It was posted on May the 22nd. Most holders and servicers of VA loans, if they have automatic authority, should be able to process those in-house in about 45 days. If for some reason the lender does not have automatic authority, the lender can take the package, all the paperwork, and send it to VA, and we will process it on their behalf in about 35 calendar days. Just some of the things to remember about assumptions in order for veterans to retain their entitlement is that in order to retain entitlement, you must do a veteran to a veteran transfer.
Retain entitlement meaning you can do another VA loan.
Exactly, and that is so important for veterans to retain that entitlement. In order for the veteran to retain their entitlement, the transferring veteran, they must transfer that loan to an eligible veteran.
And so what happens if the seller is transferring the VA loan to a non-veteran?
Then it's very possible that the veteran will not retain their entitlement and not be eligible for a future VA loan.
Okay.
And so this is why the veteran should have a very fruitful conversation with their servicer to make sure they've got all their bases covered before entering into an
How
assumption.
new is that feature?
The assumption piece?
The veteran to veteran.
I don't know the exact date, but I can find that out and let you know.
Strikes me as pretty new.
I'll find that out for you, sir.
All right, any other questions for Michelle? Yes.
So anyone could assume that 3% loan, but if a non-veteran assumed it, then the veteran would not necessarily be eligible?
Correct. Correct. For a future VA loan.
What's done to protect
This is information that the servicer should be telling them as they're processing this.
Yeah, I think these details are probably the reason that you're saying it's, you know, even though it sounds like a great idea or a great feature, it doesn't happen very frequently.
No, it doesn't. And I'll get that answer about the substitution of entitlement piece.
I think that's been around for a while, but I don't know. I'm not an expert on VA assumptions.
I've been around Washington DC a long time, and this is the first I ever heard of that.
Okay.
All right, excellent. Well, thank you all. Have a
Thank
great day.